necessary. 38 hours. 13 minutes. 14 seconds. Chapter summary. Key points to remember from this chapter include: the premium is both an exchange for insurance protection and a portion of the policy owner's consideration. Factors in premium calculations: mortality factor or mortality rate, interest factor, expense factor. The mortality rate refers to the frequency of deaths in a defined population at a specific time interval. Morbidity rate refers to the occurrence of diseases in a defined population at a specific time interval. Interest is one of the ways an insurance company can lower the premium rates. The expense factor, also known as the loading charge or factor, is derived from operating expenses, or funds the insurer pays out. Net, single, premium is a premium that makes provision for mortality, death benefit, losses only while being influenced by the interest rate assumed, gender, the benefit to be provided, and the mortality rate. Gross, annual, premium is the premium charged by an insurer comprised of or influenced by the mortality, interest, and expenses. Additional factors that may influence the premium amount include age, sex/gender, health, occupation, hobbies, habits, benefits, options and riders. Premium mode. Premium mode refers to the policy feature that permits the policy owner to select the timing, frequency, of premium payments. With single premium funding, the policy owner pays a single premium that provides protection for the life of the policy. Fixed/level premium funding averages the single premium over the policy period. Modified premium funding is characterized by an initial premium that is lower than it should be during an introductory period of time, usually the first 3 to 5 years. Graded premium funding is a contract characterized, like modified, by a lower premium in the early years of the contract. Flexible premium funding allows the policy owner to adjust the premiums throughout the life of the contract. Earned premium is the amount an insurer is entitled to since it provided coverage for a specific period of time. Unearned premium is an amount of premium for which the policyholder has made payment to the insurance company, but coverage has not yet been provided. Reserves are the funds set aside by an insurer, required by law, used to pay current and future claims. A legal reserve is the amount of funds an insurance commissioner, or director/superintendent, requires an insurer to maintain based on the mortality table and assumed rate designated by the state's commissioner or state insurance law. Surrender cost index uses a calculation formula where the net cost is averaged over the number of years the policy was in force to arrive at the average cost per thousand for a policy that is surrendered for its cash value at the end of that period. Net payment cost index uses the same formula as the surrender cost index, with the exception that it doesn't assume that the policy will be surrendered at the end of the period. The primary living benefit that a whole life, permanent life, insurance plan possesses during the life of the policy is its cash value buildup. The accelerated benefit is sometimes referred to as the terminal illness rider. This benefit allows the policy owner to access a portion of the death benefit if a physician certifies the insured as terminally ill. A viatical settlement allows someone with a chronic or terminal illness to sell their existing life insurance policy to a third party for a percentage of the face value. The original policy owner is called the viator. The new third-party owner is called the viatical or the viatee. Chronically ill means a person who needs considerable supervision due to cognitive impairment or cannot perform at least 2 activities of daily living. Terminally ill means a person not expected to survive a medical condition for more than 24 months. If the policy owner chooses to select a settlement option, it cannot be changed by the beneficiary. In a lump sum option, the death benefit is paid in a single payment, minus any outstanding policy loan balances and overdue premiums. Under the interest-only option, the insurance company holds the death benefit for a period of time and pays only the interest earned to the named beneficiary. The fixed amount installment option permits the death proceeds to be left at interest with the insurer and to pay a fixed death benefit in specified installment amounts until the principal and interest are exhausted. Fixed period, or also called period certain, the death benefit proceeds are paid in equal installments over a set period of years. The life income option provides the beneficiary with an income that they cannot outlive. Under the single, pure, or straight life income option, like a straight life annuity, monthly installments are paid to the beneficiary for as long as they live. The refund life income option, also known as the joint life option, guarantees the return of an amount equal to the principal less any payments already made. The life income option with a period certain pays a monthly income for as long as the beneficiary lives. However, should they die before a predetermined number of years have elapsed, the insurer will continue monthly payments to a second beneficiary for the remainder of the designated period. The joint and survivor option guarantees that benefits will be paid on a lifelong basis to two or more people. A revocable beneficiary may be changed or removed by the policy owner at any time without notifying or getting permission from the beneficiary. An irrevocable beneficiary may not be changed without the written consent of the beneficiary. Per capita means by the person or by the head. Per stirpes means by the bloodline. The primary beneficiary is the individual who receives the death benefit when the insured dies. The secondary or contingent beneficiary is the second individuals in line to receive the death benefit. A tertiary beneficiary is third in line to receive policy proceeds when the insured dies if they survive the primary and contingent beneficiaries. Testamentary trusts are created at the insured's death according to a will. Inter vivos trusts or living trusts are created during the life of the insured. The Uniform Simultaneous Death Act states that if the insured and primary beneficiary both die in a common disaster and it cannot be determined who died first, the insured will be considered to have survived the primary beneficiary, or died last. The Spendthrift Clause provision protects a beneficiary from creditors with regard to life insurance proceeds. Dividends paid on a whole life policy are tax-exempt as they are considered to be a return of overpaid or excess premiums. A Section 1035 exchange enables the postponement of tax consequences. North Carolina Life and Health Pre-Licensing. Online course